Just when the market seemed unstoppable, a perfect storm unleashed total chaos. Tech giants losing billions in minutes, global indices plunging, and investors everywhere asking, what now? If you're wondering how we got here and how to navigate the turbulence ahead, you are in the right place. Let's dive in and really uncover the why behind the market sell-off. Let's go.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Welcome to the Financial Mirror, and thanks for joining me today as we continue to work to improve the one thing that we can control, ourselves. Here at the Financial Mirror, it is not about the numbers and spreadsheets alone, but about transforming and educating you on money so that you can make smarter financial decisions. If this is the first time you are joining in, don't forget to hit the subscribe button on YouTube so you will be notified of all the new episodes as they release. If you're on Rumble, go ahead and hit that follow button and like the video. Finally, if you're listening to this on a podcast platform of your choice, make sure to like and subscribe there too. That means the world to the support of the Financial Mirror. So today's episode is all about the recent market sell-off. I know many out there across all forms of media have covered this topic probably at length. However, I wanted to take a step back. I wanted to give an opportunity to give you something a little different. Something beyond the emotional reactions. Everyone is panicking. Everyone is all over the place. Everyone has their own opinion. And today I'm going to give you mine, right? Like, I'm not saying this is factual. I'm not saying that everything that I say today is going to play out just the way that I say it. However, I did take a second to not just have this utterly emotional reaction to everything that's going on that you're going to see across the web, but instead offer some knowledgeable and factual next steps instead of just reacting, right? Like, a lot of people are creating videos and articles and blog posts about reactions. Like, they're just reacting to it. Instead, I wanted to dive into what led to the sell-off. Like a lot of people just go with the outcome, right? Like, they just see the sell-off. They just see all the red numbers and they're watching their portfolios just diminish. I want to talk about what led to it. I want to talk about what happened during this whole little turmoil and where we might be headed next. That's where the basis of this episode is coming from. So today, I'm going to start off and kind of just rock through this of what led to it, kind of like what was leading up to it, right? And then kind of what was that trigger? What was the trigger that put everyone into this turmoil? And then talk about some next steps and some things to watch for. So we're going to date back just a little bit, and we're going to go and say something that everyone is so tired of hearing. But back in COVID times, so you know what I mean. Everyone that became old really fast. However, back in 2020, let's just say that the shock of 2020 when pandemic hit, there was a sell-off. There was a pretty drastic sell-off. We'll say that. And that sell-off created a scary moment. Let's just say that. Like, that sell-off created a moment where we just didn't exactly know what we were going to get into. We were unsure of how things were going to go, how markets were going to react, all of those things. It became apparent that we were going to have an interesting time. We'll say that the markets definitely took a little bit of a blunder. So I wanted to pull up that chart and just show you. In 2020, there was initial shock. So right here, around this area where I'm hovering, that March, February, into February, I think the first big sell-off day was February the 24th, 2020. Huge sell-off, and it lasted roughly a week or 2 weeks, something of that nature. Big sell-off, big sell-off. Now, since then, you can see that over the next roughly 2 years, we had some pretty, so this is up until, so it's 2020 to the beginning of 2020 to the beginning of 2022. We had a pretty massive run, right? Like the world was uphinged. The central banks and governments around the world implemented these like monetary and fiscal stimulus measures that, helped drive government spending, that, we had lower interest rates. We had this, all of this was in an effort to try to ease this economy, right? Like, because it was booming back. Like it looked like things were going to be great. Like, and then all of a sudden we had a little bit of a pullback, right? Like we had a little bit of a pullback right here from roughly January 2022 until October 3rd, 2022. A little pullback there. And that was needed. Like it was good. That was good. And then since pretty much October of 2022, this thing has just been rampant. So all of that is to say that there was a lot of pressure in the market building up. Like we had this huge dip from COVID. Markets rebounded quickly. Economy was doing pretty good. And then all of a sudden, boom, we had one little minor pullback, and then it keeps going, right? Like didn't take enough of a little breath. So this injected tons of liquidity into the markets, showed and supported economic growth. Now, what was the result of all of that? All that liquidity into the market, all of that government, fiscal stimulus measures, all of those things, the monetary stimulus measures, like all those things, what did it do? Well, it reduced volatility and it led to that steady upward trend in the market. And it was steady. Like there was little minor pullbacks all there. I got it. But it was steady. And anytime, that we have that nice little steady growth, it doesn't come without some pitfalls, right? As the market was developing over the past few years, it became heavily reliant on just a few of these like mega cap like tech stocks. Think about your Nvidias, your Apples, your Microsofts, your Metas, your Amazons, your Alphabets, also known as Google. These became drivers of the market. Now, where can we see that? Well, we can see that in the simple fact that when you go and look at a like total stock market fund, so this is the Vanguard Total Stock Market Index fund right here. You can scroll down. This is on Morningstar. You can scroll down and look at the holdings and the percent of the portfolio that is held in that area. Now, look at what I just said. Major, like just a few of those mega cap tech stocks, the Microsofts, the Apples, the Nvidias, the Amazons, the Metas, the Alphabets or Googles, right? You can see right here at the top from Alphabet up to Microsoft, that's roughly 25% of this portfolio's holdings are in those few stocks. You see, there was such an emphasis on the growth that was happening in those, and you can't knock it, right? You can't knock the fact that those areas were growing. They were booming. We had AI. We had all of these things happening, and people were investing. Investors were investing. These portfolio managers were investing in those growth items heavily. Like I said, 25% of the portfolio invested in those areas. Now, these companies, that led to these companies really becoming the primary drivers of the market. So what they did is what the market did. You see that? So what the Metas and the Nvidias and the Apples and all of them were doing was driving like total market. 25% of the portfolio, the average portfolio out there was getting driven by those few stocks. So with so much riding on those like few giants in the tech field, the market grew imbalanced and very susceptible to some very sharp corrections if at any one moment sentiment shifted, right? So the market's growing, boom, 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 boom. Everything is looking good. Everything is roses. And then all of a sudden, all we needed was a slight sentiment shift to where those start to go the other direction and the market will follow. Market will follow. However, before all of that happened, you can imagine People were confident. People were complacent. People were, not really focusing on the risk that comes with investing heavily in just a few stocks, just a few companies. So that was one big part. Big part when we look at it, when we look at the stability of the market, that's what kind of created instability, okay? Instability. That was the one big thing, I would say. That's probably the biggest thing, but there's other things to talk about, Federal Reserve and central banks. They were trying to engineer this soft landing. You can see that with the overall inflation rates. You can see that with CPI data. You can see that all across the board. They were saying we are going to tame our inflation numbers and not trigger a recession. That was the goal, right? Soft landing. We heard it. Soft landing. However, by continuing to preach soft landing, by continuing to invest in these big tech, like mega cap tech stock type things, we started to ignore some of the warning signs that we were looking at. Slowing economic growth, rising inflation, geopolitical risk, political risk, right? Like being the election. There was a lot of assumption with this whole economic expansion and how that would interrupt many investors not prepared for downside risk. Okay, so that's how we got here. That's the lead up. That's 2020. What I just walked through is like 2020 till 2024. Okay, that was kind of the building momentum. Okay, then what happened? This is like you can't make this up. Like it literally was the perfect storm. And unfortunately or fortunately, whatever way we want to look at it, it was the trigger that kind of like just set it was like a domino effect. There was one trigger that potentially led to turmoil, for lack of a better term. Now, I'm saying that up front to say this, that this could have been any trigger. Like this was the trigger, but there could have been any trigger. The trigger, and go back to what I stated earlier, the trigger that needed to happen was there needed to be a sentiment shift. You needed something to shift how people were viewing the market. Because at the time, people were 3 weeks ago, just go 3 weeks ago. Let's just go back. Beginning of July, sentiment of the market was still bullish. Sentiment of the market was still, this is a nice steady growth. Sentiment of the market, nobody was thinking about downside risk. Sentiment of the market, that's where people were at. All we needed was a shift in sentiment. Where did that shift come from? Well, the shift came from the Bank of Japan's unexpected interest rate hike that led to the sudden appreciation of the yen, which is their currency. And that triggered a reversal of yen carry trade, which this is a little article from the Indian Express that talks about it. I'll share this article, but talks about what a yen carry trade is. But I'll break it down very simply, and you can go back and look at this article if you'd like. But the idea behind this is Japan had such low interest rates on the yen, people would borrow yen, their currency, and then invest it in other areas, abroad in other countries where rates were higher, right? So you could take this yen and borrow it at, let's say, like 0%, right? Like point nothing percent, and then you could go invest it somewhere else for like 4% or 3% or whatever the case is. And man, like you're borrowing against something that you're barely paying interest on, and you're investing it and making a ton more, right? So it was beautiful. And that's kind of, like I said, that's where a lot of this started at. This was kind of that first big thing, was this yen carry trade triggering that, that sentiment change. Because what happened? Well, as the yen strengthened, investors were kind of forced to start sell off positions, right? Because now they're paying more for the money that they weren't paying very little for. So they start selling off these U.S. and global assets to cover what they owed on the borrowed yen. Okay, so all of a sudden, huge sell off. They had this yen that they had borrowed off of. They had converted and invested it into, let's say, the U.S. market. The yen, now they owe more on the yen, so they have to start figuring out how they're going to cover that. So what do? They sell off, and this is worldwide, not just U.S., but just for example's sake, they sell off U.S. investments that they have to cover the cost of the now more appreciated yen. Okay, so massive sell-off starts to happen. Now, that's the trigger. That's the sentiment shift. When people start to see massive sell-off, what happens? Well, they freak out, right? I mean, most people do. Most people would freak out when that happened. So you have this massive sell-off contributing to this global market downturn. And at the time, people were expecting Federal Reserve to cut rates, right? And they had not. And so now you have this other uncertainty. So now you've taken this bullish trend that was looking like it was going to continue to grow steadily. You had this sentiment shift that changed how people were kind of feeling about the market. And now you have these things that, wait a second, I thought this was going to happen and it's not. So now my sentiment is being validated, right? My sentiment is now being said, yep, I should not feel comfortable about this. So if I have a position in a place that I no longer feel comfortable with, that I'm no longer confident in, that I no longer think is this bullish, steady upward trend, what am I going to do? I'm going to sell and contribute to the sell-off, right? So investors were consistently on edge. They were showing data that we didn't know exactly where it was going to go. And then what happens, right? The next phase happens is we start to see this kind of, as the sentiment is shifting, as people are not feeling so confident in the market, you start to have a sell-off. Now, this is what a lot of people don't think about when they think about the market. So if this is something that you're not as familiar with, but there's this thing called algorithmic trading, right? And it's literally just it's a computer trading a system, a computer trading a strategy, computer trading something, right? The computer knows the rules, not a person. So built into those trading systems are certain risk management pieces where if a certain thing happens, then I need to liquidate. I need to sell the position. So you have these systems. You have people that are now selling positions to cover their yen. All of a sudden, that sentiment change is now paired with the Federal Reserve not exactly saying not doing what they said they were going to do, or that's up for debate whatever you want to think. But they were talking about cutting interest rates and they didn't. So now people are feeling a little uneasy. So they start selling positions. And now these machines are seeing, hey, there's a lot of, negative sentiment. There's a lot of positions being sold. The market is getting driven down. So now they're reacting because programmatically they're told, hey, this is when you would sell. And so now they're being triggered to sell. And now you can imagine what happens. There is this automatical, I don't even know if automatical is a word. There are these machines that are automatically selling assets because those certain thresholds are met. And that is creating this feedback loop that intensifies the market decline. More people are selling if they didn't think they were going to sell. Now more people are selling, and now you have this market sell-off. Okay? And now we're there. We've seen the red. It's landed, and all of a sudden, people are starting to think, where is the soft landing? Where is the soft landing for the economy? And that's what more and more people are now talking about. Is we thought we were in this soft landing, inflation slowed, job growth was staying strong. Latest job report comes out, all that's in question now. Looks much weaker than we once thought. Pressure on the Federal Reserve is rising. Still waiting for those interest rate cuts, still haven't happened. You can see employment rate was coming down, and now employment rate is going right back up. We're pretty much on a 2, 3, 4, 5 month incline in unemployment rate, And we are getting to the point where there is a problem with, and this is our inflation rate. So kind of running through that. And all of a sudden we have a problem. We have an issue. And that is only being compounded by the overall market as a whole, right? Overall market as a whole. So what's to do next? What's to do next? Well, I think the biggest thing that we took away from this is how interconnected global financial markets are. And this is the first place I wanted to start. I tell you that what's happening in the United States, what's happening in the Asia markets, what's happening in the European markets, all of these things are interconnected. People forget just how reliant and when we think of things like, Forex, currency pair trading or exchanging or whatever you want to call it, there's a huge market there. And it's literally the exchanging of the value of currency, right? Literally, that's all it is. People making money on the differences in the value of the currencies. But we always forget that markets, specifically like American-based companies, are also heavily invested in other areas. That tons of companies are invested all across the world, and you're not your little pocket. And if you're listening to this and you're in an Asian market, you're not your little pocket. If you're listening to this and you're in a European market, you're not your little pocket. Nobody is their little pocket. It's literally a global market. And if you think for a second that what happens in one market is not going to affect you, the yen carry trade just proved differently. What happens in a market will impact other markets just because of how interconnected they are. This wasn't a localized event. This was a buildup over time across the world that created this sell-off, that created this market sentiment change, that created all this. It's not just the Federal Reserve. Other countries have monetary and fiscal policies that they are also enacting, such as the Bank of Japan changing the rates on the yen, right? Like, there are other countries, and all markets will feel the impact in some capacity. So I just like to say that. And then the other thing is, I think that a very close look at another takeaway from this is that NVIDIA, and I'm just going to say this, that the market's volatile. And when you get 25% of your market invested into one area, one sentiment shift, one minor change in that small little, like I said, like 7 tickers has 25% of the average portfolio. One small change will be devastating. And we can see that when we look at like an NVIDIA. This is NVIDIA from July till August, like the most recent close as of August, close Friday. NVIDIA, one of the market's leading tech stocks, shows a vivid example of volatility. They saw a $400 billion loss in market value in the matter of minutes. $400 billion lost in minutes. And they recovered a little bit of it within a few hours, right? But it just shows how fragile this market is. The stock market is fragile, especially when it's being led by a particular group of stocks, right? A particular group of companies is leading the market. And we can see that when we look across the board at all the different varying sectors across the board. Real estate up 8%. This is in the last month. Real estate up 8%. Utilities up 7%. Healthcare up 3%. Financials up 1.42%. There's only 3 markets three industries, I guess you could say, that that are actually declining right now. Information technology, which is the biggest loser right now, is semiconductor and equipment, right? Down almost 20% in the last month. You have consumer discretionary, which is down almost 10% as a whole, which are these are the industries in that market, and communication industries, which are down, but it looks like that when you break them out, it's not too bad. So let's just stick to these top two, almost down 10+%, 9.82% on the consumer discretionary, which is like hotels and restaurants, automobiles, things like that, leisure equipment and products. And then just think of consumer items and then information technology, all down. The only thing up in information technology is IT services. Only thing up. It's a big deal. It's a big deal because the tech sector has been such a driving force behind the market gains recently. For the last 2 years, been driving force behind the market gains, and it quickly became the Achilles heel of the sell-off, right? It quickly showed its volatility, right? It did. So I just want to tell you that, and that this is how, this type of stuff happens. You get so involved, so devoted to a particular area. You get so caught into like what's going on and where the money's being made, and everyone drives to it. Everyone goes to it. They get invested in it. And then this happens and everyone is affected by it, right? Because everyone kind of jumped on that bandwagon. So I'm just here to tell you that there were signs. We ignored them. There were signs across the board that this was becoming an issue. Tons of signs. And I'm not blaming anything on the yen carry trade, and nor should anyone else, because that was just the trigger that had that created that sentiment change. The shift in sentiment happened when that happened, right? If people would have been super bullish on the market and they already weren't shifting toward a negative sentiment, that yen carry trade would have been a slight little pullback like we've seen time and time again in this big bullish trend. However, that compounding with a lot of other things, Federal Reserve, geopolitical issues, war in the Middle East, or potential war in the Middle East, whatever you want to call it, all of the current election year, like the issues that come with that, the uncertainty that comes with that, all of that being said, that we could see this was showing up, that this was starting to present itself. And there's this thing out there, and it's called the VIX, and it's like a volatility index, right? And it's something that people look at, and it's kind of used as like a fear gauge for Wall Street. And it's been slowly climbing, right? Like, so from about end of July, let's go back 3 months. So let's go back to this whole July time frame. We're down here around like 10, 13, 15%, right? Like, and then all of a sudden you can see this thing rising. Boom. August the 5th. Just before that crash, or day of that crash, whatever you want to say, like in that ballpark of that pullback, huge market sell-off. This is all that market sell-off these days. Beginning of August, boom, explosion. And you can see that. And in comparison, this is nothing compared to, like, let's go back to like the COVID one. This is the COVID one, like VIX was up like 66%. So nothing in comparison to that. However, still a pretty good little bump up. I mean, you have to go back to 2020, the beginning of 2023, to have a VIX even close to being in that area. Well, I guess right here, end of 2023, VIX kind of shot up a little bit, but just a little gauge that people use just as fear. It's just a fear gauge. How are people thinking about volatility in the market? And all of these things kind of compounding. We could see the signs. We could see the uncertainty with the Federal Reserve. We could see all of those items adding up. Now, what can you do next, right? So we kind of walked through this. What led up to it? What was that trigger? What kind of was some of those signs that we missed? But what can you do? Kind of looking ahead, what can you do? One of the biggest things that you can do is make sure that you're balanced in your portfolios. All I'm saying is, this could be, if you're highly exposed to these high risk sectors, such as the overvalued like tech stocks currently, maybe think about allocating or going into other funds that are maybe more undervalued. Speak with your financial expert, whoever your financial advisor is, and see what those options are to maybe pull out of some of those areas that are just diving headfirst into this big tech stock boom. See if you can figure out ways to avoid that. That's one thing. So get that balanced portfolio. This could also mean, investing into other markets. So if you're currently only invested in the U.S. market, maybe there's an opportunity to get more into some of the international markets. But that's one thing you can do is get that very balanced portfolio, because then you can withstand some of this market turbulence. It's also crucial to maintain a long-term perspective. Even with all the commotion, all the turmoil right now, keep a long-term perspective on your investments. And I'm not talking 20-year long-term. I'm talking like give this thing a year and things will look better. Give this thing 2 years and things will look better. Like things like the market shifts. The market shifts like weather, and you got to just give it time. History shows markets tend to recover over time. So be patient. Patience and discipline are essential when you're invested. Finally, one of the last pieces of advice I would give is diversification into different asset classes, different areas are always great. So not only being in the stock market, being in the bond market, investing in other commodities like gold and silver and whatever, what other commodities you think about. Getting into some safer investments, and like CDs are paying like decent amounts right now, but like just really moving around and seeing I bonds, for instance, another good spot to be, but just get around and see like other areas that you can put money into to invest. It doesn't just have to be the stock market. So that's just another good thing. But the last piece that I would tell you is keep investing. This is not the time to stop, even with all the downside. Even if it continues, it's not the time to stop. History is on the side of the market that it will bounce back. And so every dollar you invest now could turn into future gains in the future. So keep that on the front of your mind. Keep thinking about that. Just keep putting money into the market. And don't stop. The worst thing you can do is stop and then start buying when it starts recovering. You're missing some good opportunities to lower your cost basis and just get better investment prices. So hope you got something out of this episode. Thank you for joining me today on the Financial Mirror. This episode was all about just informing and empowering you. Everyone else had reactions. I watched a few of them just as I was kind of going through this and prepping, and everyone had a reaction. And I would tell you that you can have a reaction, but let your reaction lead to an understanding that you can grow from and you can kind of be on the lookout for. So when these things start happening again, you can be more prepared, even if it's just emotionally prepared. Like, all right, I guess we're about to see another sell-off, right? Like I predict another sell-off. But that's really what the position I wanted you to be. I want this to be slightly educational and less reactionary, right? I didn't want to create this big, I didn't want this to be just all about clicks and getting people interested in to watch my video. I wanted to educate you so that you can start to see these things as they're happening, not just sit here and get you all in an uproar over Federal Reserve not cutting rates. All right. So anyways, let me know your thoughts. How are you starting to navigate this market volatility? Are there specific topics about the market that you want me to cover in future episodes? Just post those in the comment section. I'd be happy to take a peek at those and figure out how to get those into the schedule. So stay smart, stay focused, and remember the key to financial success is not just about what happens in the markets, but how we respond to it. Okay. So if you do need some support, you do need some help kind of reaching your financial goals, just head over to thefinancialmirror.org and hit book now and schedule a free consultation today with me. We'll get you on the right path to your financial goals. If you do want to get an extra dose of support the stream, head over to thefinancialmirror.org/shop and pick you up some awesome Financial Mirror gear. Truly appreciate everyone tuning in. Every week we do a new episode, so tune in next week to catch the latest on personal finance and how to improve yours. So until next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.